So I'd like to have a conversation with you that I've actually had many times, but in a different context. And the crux of that conversation is, what does Dad do, and why does that matter? So for the past 30 years, I've worked in the insurance business. And for the last 12 years, I've focused specifically as a cyber broker for energy and power organizations. And I have a wife who's a pediatrician and 2 daughters who are young adults. And as you can imagine, it's a lot easier for them to understand what their mom does every day versus an insurance broker. So, as an insurance broker, you're really trading risk. You're transferring risk from one party to another, and you're doing it for a premium that both of them have to agree upon. In order to do that effectively, you've got to be able, in cyber, you've got to be able to understand it. You've got to be able to quantify it. You've got to be able to convince an insurance company to assume that risk at a premium amount that is actually acceptable to the original buyer. Now, at that point, I've lost my youngest daughter and my wife as well. But I know you guys are also in another area of risk management, so you can understand what I'm talking about. Cyber insurance has been around for over 20 years, but the energy and power cyber segment is a very highly specialized subsegment of the cyber market. The news you hear about the general cyber market is sometimes applicable, but it's really sometimes its own little microcosm. If you were to, say, survey the largest 25 power and utility organizations in the United States, you'd find out 2 things. One is 24 of the 25 buy cyber insurance, and 2 is that the insurance company they use you probably have never heard of. So it's a highly specialized segment that really needs a lot of more maturity, which I really do think the OT security insights that you all have can greatly help inform the space. So I think that the current level of maturity is ripe for collaboration between OT security professionals and the insurance marketplace. In any event, as the title of the topic suggests, this is about spreading and sharing the risk. But there's really like 3 big ideas I'd like to kind of go through today. One is that insurance risk management isn't always insurance. 2, the current level of maturity in cyber insurance for energy and power is such that it really requires a lot of strategy to be effective. The more strategic you can be about it, the better outcome you're going to have. And 3, I think as OT security professionals, if you take some time to understand this area of insurance, there are some benefits that you can have both for yourselves and for your organizations, and I think we can together move the ball forward. So let's start off with a couple of the surveys that I appreciate you completing in advance of this session. So first was, have you had any involvement with your organization's consideration of cyber insurance? The vast majority were no, but about a third was yes. And just observation there is what I see when professionals from the OT security environment start to interact with insurance professionals. The first thing you hear are a lot of skepticism. So are cyber claims paid? Are insurance companies trustworthy? I can understand these kind of questions, and they're really fed a lot by the headlines. If you read about cyber insurance and energy and power, or in general, you hear a lot of news about insurance companies not behaving well. As one example, after NotPetya, a lot of insurers found themselves in court, declining coverage for large cyber business interruption claims, and in court, actually, judgments went in favor of companies like Merck and Mondelez against their insurers. I do want to remind you, though, that that was actually a property insurance policy and not a cyber policy. So dedicated cyber insurance is a microcosm within this. In my experience, and as a broker in this space, I represent the buyer, so I don't overly defend the insurance companies, but my experience has been that, in general, cyber claims are, in fact, covered and paid most often. The underwriters, on the other hand, have their own biases, and there's a whole segment of underwriters that really think that energy and power is an excluded class. They don't want to touch this space. They feel like the upper end of this risk is just too high, that there's systemic risk, and that past performance doesn't necessarily indicate what could happen in the future. It's a sort of risk that could really blow up on them, and a lot of underwriters don't want to hold the bag for that. So underwriters have their own biases about pricing levels and where it should be, but in general, there are a lot of markets, or at least a subsegment of markets, that really do focus on your space. And the ones that have, over the last 10 years, have done really well. So they've been very profitable, and they've been rewarded for that. But the market's really a smaller market, and there's really only about 5 or 7 insurance companies that I place primary coverage with for our energy and power clients. So it's a much smaller segment. The ones that have done extremely well. So next topic was, next poll question was, have you met your cyber insurance broker or underwriter? Again, majority no, about a third yes. For those of you who haven't met your broker, it's nice to meet you. The first observation I would have in this would be when a security professional meets an insurance professional, very different languages. You know, we're both in risk management actually, but the language of a security professional is, there's tons of acronyms. The same goes for insurance. It's not really a huge language barrier. The fortunate thing for you is that cyber underwriters are tasked with understanding your language, and they do study it, and they generally understand you. You may have to have a primer on insurance just to understand some of the terms that we have, and certainly that's something that is doable. Last poll question for now is, have you been involved in a cyber insurance placement or policy renewal? And similar to the other responses, about 40% have been involved, so that's great that some of you are engaged, but the majority have not. So with that, let's start with like the real basic fundamentals, and if you could bear with me here, I'm going to go through the key roles first, and we're going to build off of this. So the 3 roles to understand are, 1, there's the buyer. The buyer is represented by usually a risk manager or some insurance manager that represents your organizations. There's a broker who's the intermediary, that's me, and there's an underwriter. Now, the underwriter represents the insurance company, and the underwriter assumes the risk. As a broker, I don't assume your risk. You could have a really bad risk, and sometimes I actually really enjoy working with companies with a lot of risk, a lot of complexity. It's challenging for me, and it's rewarding. I don't actually have to pay the claim if one arises. It's the insurance company that pays that. But the buyer's priorities are really, cost. You want to pay as little as possible for your insurance. Coverage, you want it to be as broad as possible, obviously. You want a carrier that has good claims reputation. And then you want an insurance product that's going to support your incident response. There are different ways that these insurance products deal with incident response, so that's an important detail just to understand when you go into the product. The broker's priorities are really to keep you happy. So the broker is hired by you, fired by you. It represents your interests. It's supposed to advise you through the process, help you get the best terms and conditions, the best outcome, the best claims response, et cetera. The broker is also trying to manage expectations because at the end of the day, my clients want to pay as little as possible. So I have to make sure they understand what the parameters are, who are the insurers we might be able to go out to, and manage those expectations about what we can expect to achieve. But ultimately, the broker wants to achieve what's called an efficient risk transfer. Now, what that means is that with an efficient risk transfer, there's an economic benefit for you from buying insurance. It's basically in your best interest to buy rather than not buy at that price. And ideally, this should be sustainable over time, where that economic benefit occurs for both the insurer and the buyer. Now, the underwriter priorities are profitability of the whole portfolio. The underwriter can take a loss. The underwriter might charge you $100,000 and pay you $10 million, but if they're okay on the portfolio, they're fine. So their key objective is to avoid unattractive risks, either to price it higher to compensate for that, or to decline and not cover unattractive risks. They're looking to seek attractive companies that are going to fit their portfolio, and at the end of the day, they want shareholder return and cash flow. Now, I used some Lego figures here and borrowed them from last year's cyber presenter, which is Mona Tigliano, who's in the audience right now. And I made one key change, which is that in my presentation, I'm talking from the perspective of the buyer. And so I've kind of put the hero figure as the broker for today. Last year, the hero figure was the underwriter. And arguably, the underwriter is also a hero too in this transaction. The underwriter is actually providing the solution. But in the way I work every day, from my perspective, I'm negotiating that solution and optimizing it. So we're going to get into some of the ways I do that. Before we go there, let's discuss the type of insurance companies. There's 3 types, and this is where it's going to start to get interesting. Not quite now, but in the next slide. But commercial insurers are what you normally think of in terms of insurance companies, right? These are the AIGs, the Chubbs, Travelers, Berkshire Hathaway, Hartford. These are companies that are owned by shareholders, and their objective is to make money. They are profit-focused. So these entities are looking to exploit risk. When there's opportunities where there's risks and they can get a premium for it that is in excess of what that risk is to them, they're going to invest in that and they're going to provide what's called capacity. These types of entities will do lots of different risks across different industries, different coverages, and their objective is basically make shareholder returns for their shareholders. So they're looking to always have a good enough margin on that they're getting good returns. They've got very diverse portfolios, and they're huge. Some of these have like hundreds of billions of surplus. So these entities really are able to take on a lot of risk, and at the end of the day, their objective is to charge you as much as possible. They're the capitalists of insurance. And I think when people think of insurance companies, and especially if they don't like insurance companies, this is who they think of first. It's the commercial insurer, because at the end of the day, the commercial insurer is trying to win that trade with you. The next segment is where insurance isn't always what you would think. So mutual insurers are member-focused. And it might surprise you. I'd actually be interested to know who in the audience, anybody have heard of Aegis before? I know some people have, but folks heard of Aegis before? So that's interesting. So Aegis, a lot of you are all for the energy and power sector. Aegis is the by far leading insurer for cyber risk for energy and power organizations. Aegis and these other mutuals are what we call member-focused. They were set up by your companies, established by them, and they are owned by your companies. So these are companies that are focused on financial stability, but they're really focused on their members. So they're not trying to make a shareholder return. They're not trying to get 10 or 12% shareholder return. Instead, they're just trying to provide an insurance product and then remain stable. So what that means is that as they grow and they take on surplus, if that surplus is in excess of what they need to write their premiums and to assume risk, they start to return that to the members. And in cyber, it's actually kind of uniquely optimal in this space, because cyber is the type of risk where the fair price isn't really known. So for the commercial insurers, the fair price is a market price. It's basically what happens is there's cycles. There's what we call hard markets and soft markets. As risks become problematic and insurers have losses, insurers pull out and the prices go up. And so there's like sort of a market mechanism that controls it. But with mutuals, they basically make assumptions. They say, well, we think the risk is going to be this. And they price the policy that way. And then over time, if it turns out that they overcharge you, they actually do give you the money back. And the reason why they do that is because you own them. So companies like Aegis, EIM, Neil, and Everin have that unique feature, which is attractive by a lot of your organizations, especially in the energy and power space. And they all have their sort of unique focuses. But the idea here is that they are returning policyholder surplus to their members. The downside is that they're less diversified. So these are not 100 billion size organizations. These are organizations that might be a couple of billion to 5 billion in surplus. But the upsides are significant. They have lower sort of volatility in pricing, and they can be creative on coverage. So a mutual can step in. The members can decide what they want to do. They can decide they want to cover cyber risk in a certain way. And so when the mutuals came out about 10 years ago and started providing a cyber product that was bespoke for energy and power, that's really what started getting buyers in your space. So since then, we've had a significant amount of energy and power clients now buy the products, and the majority of them actually use these folks on their program. The third type of insurer, and this is where it starts to get really strategic, is a captive. Captives are self-centered. Captives are owned by you. They're owned by the policyholder. They're formed by the policyholder. And it's basically a captive strategy as a way to finance self-insurance. There's a number of different kinds. There's single parent captives, which is, you are the only company that owns one. There's protected cells where you might have a group that owns them, but they're all in protected cells so that one captive doesn't affect another captive in terms of losses. There's risk retention groups and group captives, which are captives owned by a bunch of different people. Edgeware is noted on here. Edgeware Re is a recent captive that was established just for cyber risk. And it's focused on cyber risk, and it's is launching in about a month. There's many strategic uses for a captive. So once you have a captive, if you do have one, you can really think about risk in a more strategic way. You can decide, as you analyze the cost of insurance, where you want to self-insure and where you want to transfer. And this is where it gets really interesting, because you might have a cyber insurance policy that has 100 million limits or 200 million limits, or you might only buy like 10, 50 million limits, depending on your size and your complexity. But along those areas, there are places where we would say the transfer is inefficient. So if the transfer is inefficient, say at your retention level, and you get a good credit for a high retention, that might be a place where you actually deploy your captive and self-insure that risk strategically. Or if that's not the case, you get a better credit by buying less limit, then you might use your captive up on the top. In general, these three insurers are all in the mix. And for strategic placement of cyber insurance, you're using all three. So our most sophisticated clients that are sophisticated risk managers that understand the space really well, you don't just rely on commercial insurers. You use your mutual, you use your commercial insurers, you use your captive. And then at the end of the day, you put them together to get the best outcome. So what are some of the factors that affect how you do this risk transfer strategy in cyber? First is this sort of renewal pricing trends. As I mentioned, commercial insurers are more cyclical. So you will have situations where pricing sort of spikes and drops. It's a cycle. We call it hard market when the prices are going up, soft market when they're coming down. Underwriters are chasing business in a soft market. They're withdrawing in a hard market. And those actions by the underwriters affect the price of the product. The blue line there represents the commercial markets, and what you see is that after NotPetya in 2017, commercial prices went from decreasing every year to going up, and when the ransomware really started to accelerate, they really spiked. So insurance companies in 2021, commercial insurance, were more than doubling in pricing. Now, there's a number of factors that cause that, and when insurance companies were chasing cyber risk, they were doing it not that dissimilar from like the mortgage crisis. They were basically saying, give us a questionnaire that says your organization name, your revenue, and what kind of business you're in, and we'll provide you a cyber quote. So that sort of underwriting with a lack of emphasis on controls resulted in policies really not being priced appropriately for the risk, and insurers were basically chasing it. And then what happens after that is claims come in. And since then, underwriters have really gotten, better at this. There's always room for improvement, but underwriters do have examined a lot more about controls. The red line is the mutuals, though. The red line is much more smooth. So when you're dealing with a mutual insurer, you have a situation where the carrier is not chasing the market as much, and they are basically chasing their own assumption. So if they're pricing in a way that they remain profitable, then they're going to stay roughly there. They feel like they need to have an increase, they will, and they did. After Colonial Pipeline, there was certainly some reaction in the insurance market that, especially in energy and power, that there might be heightened risk. So another factor that might influence your sort of risk transfer strategy is the maturity of these solutions. If you look at cyber insurance, it's about $13 billion right now globally. In the US, it's about $7.5 billion. But in comparison to the entire insurance market, it's less than 0.01% of that market. So cyber insurance is sort of, as again, a real smaller microcosm. It's definitely maturing a lot. $13 billion is no small number and can assume a lot of risk. There hasn't been anything approaching a $13 billion insurance loss in cyber. Over the last number of years, cyber always grows at least 20%. So it's a growing area, maturing area. But the last bullet there kind of refers to the fact that it's got a 60% loss ratio. So if you think about it, the insurance company is basically taking $1 from you and only paying 60 cents back. So who would want to take that trade? Nobody would. It's sort of, the trade's not in your interest currently. But does it mean you shouldn't buy? No, of course not. I mean, the reality is that in this space, we don't know if next year is going to be worse than prior years. And there is sort of an unknown feature of this risk that the underwriters are pricing in. But as I mentioned, when we're dealing with commercial insurers, they are going to pay you what the demand is and how that sort of works out in the market. So they are going to work to like a 60% loss ratio. Now, it might surprise you that in energy and power, that loss ratio is actually a lot lower. So in energy and power, it's more like they take $1, they pay you 10 cents. And that's because in the energy and power space, honestly, you guys have all done an awesome job. You haven't had as many losses in energy and power, and we'll get into that shortly, but the loss experience has been phenomenal. So when you get into these things, it's kind of hard to know what the real fair price should be for this insurance. But again, as I mentioned with the mutuals, there's this mechanism whereby if their assumptions are wrong, you do have the ability to capture that back. So all this kind of demands a good strategy when you get into placing cyber for energy and power organizations. First, there's what is it that we're really looking to ensure, the risk identification, some level of modeling. We do a lot using insurance claims data to actually inform our clients about what the potential losses might be. Reviewing security controls and the communication of those. So as I mentioned, there was this period of time where the application was very light, and it's gotten much more robust. Some would say too robust. We do a lot of, what really I think helps here is like the conference calls. When we do a call with your CISO and your security team and the insurance underwriters and really explain the context around your controls, it really helps quite a bit. So there's the incident response considerations. We do a marketing strategy. You're bidding the program to get the most optimal price, and you're negotiating the coverage in the strategy. At the end of the day, you're choosing a primary insurer that's the sort of the best option in the excess. And then you have like a program optimization where in your program tower, where you have all these insurers participating, you're using some commercial insurers, some potentially some of your captive capacity, and some of the mutual insurers as well. So next poll question was, has your organization had a cyber incident that resulted in an insurance payment to reimburse your loss? So I pretty much knew what this answer would be because I know what the loss trends are in your space. The answer was, by the time this was published, there was actually, everybody either said no or not sure. You never used your policy for a claim so far. If you actually go in the app now, there's 2 respondents that said yes, but that had been done after we published the slides. Why is that? So if we look at our data on our clients and the incidence of cyber claims, they're much higher in healthcare and communications technology, whereas power, utility, and energy is either often not showing at all or one of the very lowest in terms of frequency of loss. So fantastic job. Like really, you guys, and it is a tribute to you in securing your organizations and your systems that you have the lowest frequency of cyber claims really amongst all our industries. And this sort of graph is true quarter after quarter, so we see it frequently. And so then what are some other areas? And I think some of it is attributed to you and your great work, and some of it is also just sort of the dynamics here and what the insurance policy really covers. So as I look at it, there's kind of 2 hacker motivations. There's a financially motivated hacker that's looking for the ransom, for the extortion. They've got demands, increasing in size or causing business interruption. At least historically, there's an apparent focus of these hackers on these softer targets. It's sort of like it's easier, if you're a hacker, I think it's easier to go after a hospital or health system where there is vulnerability and there is like a willingness to pay because people's lives could be at stake. It could be completely immoral to do it, but paying the ransom is something that is likely going to happen because that hospital has to function. But hacking a hospital is not an attack on our critical national security. So you're not going to have as much of a Department of Defense reaction, a reaction from the FBI. You do have some of those reactions, but Colonial Pipeline, if you look at that in contrast, that was the first time the FBI actually clawed back the ransom. And in fact, like the hacking organization somewhat apologized. Anonymous issued a sort of acknowledgement that they would vet their targets more closely in the future. So underwriters were a little bit worried after Colonial Pipeline that would be a recurring thing, but it really hasn't recurred. In your space, what I would say is there is a lot of military motivated hacking going on. As we all know, cyber is a key part of military strategy for every country, for us, for our adversaries. It was discussed in some of the talks yesterday as well. But that sort of activity hasn't resulted, at least in the United States, as an insurable event. And if it did, there is a war exclusion in the policy. And I'll throw this out as basically the most controversial thing in cyber insurance right now is a war exclusion. And as you are buying a policy, I would actually suggest it's probably the most important thing for you to look at. There's several varieties of the war exclusion, but this is an exclusion that really protects the insurer from a lot of systemic loss and from loss that they feel is too, more than what they want to take on. But some of the war exclusions out there do exclude nation-state attacks. We would never recommend that sort of approach on one of our clients, but some of them go that far. Others are based on sort of impact of the event, if it impacts the host country, and others are more tied to sort of physical or kinetic war and whether it's actually tied to an actual physical war. So there's different varieties of it. It's definitely an area to look closely at and a topic that's worth discussing further. Some other areas where insurance can sort of add value is when we get into claims data. So we use claims data to do modeling. If we have, and I think this is an area where insurance can contribute to your risk management areas as well. There's a lot of information that we have, and we start to collate it based on claims that we have as an organization, as well as all of our partners, and we buy it from other third parties that track this information as well. And we can sort of correlate that data with different features like the size of the company, the type of industry it's in, and draw some conclusions like what is the expected likelihood of an event for a particular organization, and what are the potential severity of those events, but in terms of statistics like averages, 1 in 100 event, et cetera. So we do a lot of statistical analysis to help our clients understand what sort of limits they want to buy. And then there's also a way that we can use this data for insurance program optimization. So back to the whole strategy of what insurer you use, what do you want to self-insure, what do you want to trade. When you look at it this way, you can actually apply actuarial models to the data. If you expect a certain amount of losses based on historical, and you decide that maybe buying it is not economical, then you don't buy at all, or based on the pricing that is being offered to you, or maybe you decide to self-insure some parts of your program just to get the optimal mix there. Talked earlier about communication cybersecurity controls. This is a developing area. It's definitely an area that can be better informed by your insights, and I would welcome more engagement on that. But it's certainly much more robust. I think the best communication of cyber controls, sort of aspect of it, how we deal with this is when we do those calls. Getting to know your team, getting to know the context. At the end of the day, insurance is about trust, and when you get an underwriter that understands all that you're doing to protect your organization and they can hear you explain it, it's really the best way to get the best outcome. Now, understanding cyber insurance coverage is important, and I would say this is probably the first year, if you haven't been engaged in cyber insurance yet, this would be where you'd start. You could start with this by having a discussion with your insurance risk manager. Reach out to me. Happy to do a talk on that. Last poll question was, do you interact with your insurance risk manager of your organization? And again, similar to the other ones, mostly no, but a good amount say yes. I would say that that's really the first place to start. So you don't realize how much your insurance risk manager needs you. Your insurance risk managers generally do not understand the language of cybersecurity controls. They just scratch the surface. So to have your expertise, it provides a lot more credibility to them when they're talking to us and to insurance underwriters. So getting involved is really, I think, would help them probably more, at least as much as it would help you. So why should you get involved? Well, honestly, I think the insurance data alone is actually helpful. I think the sector it would benefit from your involvement and your engagement. It could help us get more efficient risk transfer. And at the end of the day, brokers and insurers they value relationships. So they value trust and credibility. And we do try to build that between our clients and the insurance companies, and you can certainly contribute to that. Ways to add value, your cyber insurance risk manager needs to complete a cyber application, and they don't know how to do it. So any sort of help that you would do on that is definitely appreciated. Request a broker meeting. Well, we'd love to give you a 101 class on how the product works, what you can do to support favorable renewal outcomes, et cetera. And with that in closing, I think I'd just like to offer an invitation. So I do feel that the OT security risk management space is something that you have insights that would really help us in the insurance side. I've thought about doing a sort of a community sort of group Zoom call monthly or bi-monthly, and I have a number of colleagues and associates, underwriters, risk managers, wholesalers that are also interested. So if you're interested in getting engaged like that, please reach out, and I'd love to include you. So thank you very much for your time.